Let's move on here to Zoom because growth concerns are sinking shares of the company in the session right now, down just over 13% right now. The company beat on the top and bottom line with revenue up 367% on an annualized basis, but the software company's increasing reliance on free users, leaving some investors a little weary today. Let's bring in Keith Snyder. He is a research equity analyst at CFRA. And Keith, let's start with the moves we're seeing in the session right now. How much of you think is this justified, just given the huge growth they saw in the quarter?
I mean, you're right. So, growth was absolutely spectacular, but no one was really expecting anything less from Zoom. Zoom has really become the poster child of COVID-19 growth. And so, the big concern here is how long can they keep this up? You're looking at a company that's trading at, 45 times revenue. And it's, even though they continue to grow quite well, it's, they're going to start coming up on tough comps, not next quarter, but the following quarter of, they're going to cycle the COVID outbreak. And so really, where does the growth continue to come from? And you're right, free users have been a big plus for them, and that's actually been weighing on their gross margins quite a bit. As they've been doing a lot of offers for education programs. Thanksgiving they gave away where they took off their cap on the number of minutes you could use. And so all these programs are weighing on their profitability. And, the question becomes, how long can you keep adding customers at, a 500% clip?
Yeah, Keith, when we think about it, it's tough to find misses, as you said, top line beat, bottom line beat. And the revenue growth is just insane. But it was gross margins, I guess, if you had to pinpoint one, it was only 68.2%, analysts expecting 71.8%. But overall, when you step back and look at the growth story here with Zoom, is it safe to say that it's over since we're seeing shares get shellacked today? Is that really the takeaway, or is there hope still that as we approach this kind of new normal versus a full return to the way things used to be with everyone going into the office? What's your expectations for maybe once we see this choppy trade smooth out a bit, where Zoom's sitting a couple quarters down the line?
Sure. And so, I've thought that the party was over for a long time, but they continue to, outperform my expectations. But coming up, you do have a few headwinds. Obviously, a COVID vaccine coming out will kind of, take away that growth that they've seen. The new normal it's anybody's guess what new normal actually means. What we're thinking right now is a new normal is going to be a mix of telecommuting and in person in the office, but obviously not at the levels we're at right now. We're at about 45% of people are working from home right now. We see that dipping to about 20% post-vaccine. That will still be up from, call it 12 to 15% pre-COVID, but it's nowhere near the levels we're seeing right now. And so Zoom will still be an integral part of your work life, but it's they won't be able to add customers at the same rate that they've been doing over the past 9 months, given that people will be returning to the office and more in-person meetings will be taking place. And so, you're right. We think the party is kind of going to come to an end over the next quarter or two. It's just, how quickly does that growth rate drop off? Is it going to be a steady curve down, or is it going to be a cliff? And that's really kind of the top concern on investors' minds right now.
Keith, on the issue of declining gross margins, how much of those free users can actually be converted into paid users, you think? How should we be looking at some of those numbers?
So, the free users right now, it's tough to say. I don't think there will be a very high conversion moving forward. I think the customers who needed to adopt Zoom for either business reasons or personal reasons have already done so. So that growth has already shown up in either last quarter's number and maybe to a smaller extent this quarter's number. Moving forward, I think the free users who are using the platform have no intention of paying for it. And so they will just continue to use it as a free service for social reasons or for whatever they're using it for. And so I don't really think there's going to be a huge conversion of those customers over the coming quarters.
And Keith, a competitor here, Slack, we're watching that one very closely because the expectation is Salesforce could reportedly announce an acquisition of Slack by the end of the day today. How much of this do you think is driven in direct response to the kind of growth we've seen from Zoom and Slack just not being able to compete on a significant level?
So Slack has actually really struggled, and by struggle I mean they're not growing quite as fast as Zoom or any of the other platforms, and that's really boiled down to Microsoft Teams. Microsoft has integrated Teams so closely with Office 365 that Slack really had a tough time selling customers on bringing in a new platform when Teams, quite frankly, offered a lot of the same features. And so for Slack, actually, we think a buyout is kind of the best case scenario for shareholders. And with Salesforce behind them, really, we see them duplicating Microsoft's strategy. So they will tie it in very closely with their platform, which already has widespread adoption among companies. And to be able to offer, unified communication services on top of the Salesforce platform makes it a much more valuable proposition for companies. And so we like the combination of Slack and Salesforce just from a competitive standpoint.
Yeah, and Keith, I mean, the other thing to mention there too is Slack's obviously one of those products, if everyone can remember, to when they were working in the office, it was something that you could use while you're in the office. Also, when you're outside the office, it didn't really matter so much as we think about this traditional stay-at-home trade, as we've been talking about it. Of course, Zoom, on the other hand, if you're not going to see anybody in the office and you got to have calls like this, you're going to be firing up your video conferencing here. So I guess when you step back and look at where we're sitting, as we talk about Zoom and Slack, what do you think that the move we're seeing today in Zoom shares maybe signals about the other stocks that we would consider here in the stay-at-home trade as well, in terms of how much weight is being put on the fact that, look, the party is over? And I know you're talking about maybe not seeing a cliff, maybe a rolling kind of resumption to the old way of doing things over the next couple quarters here. But what does it signal to you when you look at some of those stocks that have been looped in together?
Sure. So, I mean, we have kind of bunched them into two categories. We have the stocks like Zoom, where a return to normal office life is, quite frankly, a strong negative for them. But then you have stocks like a DocuSign, where companies have adopted them out of necessity, and quite frankly, we think that they will continue to use the services as they seem like, hey, these actually have saved us money. It makes things easy. We can continue to use them even if we return to the office. And so companies like DocuSign, we have a much more rosy outlook for them, given that we think companies will just continue to use the services. Outside of that, they're really the only pure play unified communication companies that you can trade. You then look at Microsoft Teams as part of Microsoft, WebEx part of Cisco. These are all grouped in with much larger corporations that have, they're a very small percentage of their overall business. And while they have performed well, it really doesn't affect the bottom line all that much. It's more of a customer retention tool. Looking at Cisco, they want to sell you hardware, but the fact that you also adopt WebEx, it has a very close tie-in with their hardware. They want to provide you the entire ecosystem rather than just a single product. And so WebEx for Cisco is more of a selling tool than it is a bottom line driver.
Keith, going back to the deal between Slack and Salesforce, we're looking at a half cash, half stock deal here. And to Zach's point earlier, we've seen a huge surge in the stock for Slack. It was up as much as 7% today. It's up nearly 2%. Salesforce going in the other direction, which of course is not really surprising when we see these kind of mergers. How much more value do you think this kind of deal, this partnership, this merger can unlock for Slack if it is seen as one of those names that just haven't been performing up to potential?
I mean, I think it can unlock a ton of value just because Salesforce is the go-to platform for a lot of companies. And so to be able to tie in Slack-like tools, messaging, video communications, everything that Slack offers, it's, going back to kind of the WebEx analogy, it provides a selling tool for Salesforce where there's, they're not necessarily looking to make a ton of money off of these tools, but it makes their platform a lot more appealing to potential customers, much in the same way Microsoft did with Teams. And so, we see them replicating that strategy.
All right, the latest there. Keith Snyder, CFRA Research Equity Analyst. Appreciate you coming on and chat. The latest there on
Sure,
the
thanks for
work
having
from
me.
home trade.